And this is a where these oil companies have to do their part. And they could do that by alleviating some of the pain that Americans are feeling. Look,
we'll be watching.
The American people aren't stupid. They see it as price gouging, and we have the evidence that it is.
Okay. All right. Thank you, Congresswoman Schakowsky, member of the Energy Subcommittee. Illinois, right?
Yes, I'm from the Chicago area.
Fantastic. All right. Good to have you on. Thank you.
Good. Thanks so much.
Well, it is just after 7 o'clock on the East Coast, and you are watching Squawk Box right here on CNBC. I'm Becky Quick, along with Joe Kernan and Andrew Ross Sorkin, and we have a big lineup coming in the next 2 hours. We're going to be speaking with AOL co-founder Steve Case, Starwood Capital's Barry Sternlicht, Missouri Senator Roy Blunt, and CalPERS CEO Marcy Frost. In the meantime, check out the futures. They've been in the red this morning. Right now, Dow futures down by about 175 points. The S&P futures down by 31. The NASDAQ off by 162. And this is coming, continuing the losses that we saw yesterday.
Okay. Let's get over to Dom Chu, who's looking at this morning's pre-market movers. Good morning to you, Dom.
Hey, good morning, Andrew. So some stock-specific stories are driving some of the pre-market action as the pre-market trading volume starts to accelerate. We'll start off first with electric vehicles, and one of the smaller ones. We always think about Tesla, but Rivian is actually up in the pre-market trade, just about 2% right now off its pre-market highs. The reason is because after yesterday's closing bell, Rivian came out and updated investors and the public on some of its production numbers. They made over 2,500 vehicles in the first quarter of this year. And maybe more importantly for a lot of investors who are looking down the line, they say that they're on track to meet their total production target for this full year of 2022 of around 25,000 vehicles. So those particular headlines driving that Rivian trade up about 2% in the pre-market right now. Also watching what's happening with the semiconductors and technology overall. Intel specifically down about 2/3 of 1% right now, a Dow component, maybe adding to some of those losses that we are seeing in the pre-market trade for the overall indices. Intel, the latest big company in the U.S. to suspend its business operations in Russia. You may recall that just last month, in the wake of Russia's invasion of Ukraine, they had already suspended shipments of chips to places like Belarus and Russia. Well, now they're just suspending business operations. They say they've taken business continuity measures to ensure a minimal impact on supply chains. So watch Intel shares. They do condemn, by the way, Russia for their invasion of Ukraine. And then big tech, very much a focus here as interest rates creep higher, 2.64% the last trade for 10-year note yields. As interest rates creep higher, it always brings up the conversation of whether valuations, specifically in big tech growth companies, are worth it at these levels. NVIDIA right now down about 3%, Tesla down 2%, Microsoft and Apple down about 1 to 1.5% as well. So big tech, a big focus as interest rates rise. And then today is the kickoff to Bitcoin 2022. Thousands of folks, crypto enthusiasts, novice experts, all descending on Miami, April 6th through 9th, one of the biggest conferences of the year in the world for cryptocurrency enthusiasts. Right now, Bitcoin prices off about 2%, 44,900 thereabouts. Ether, Solana, Cardano, Algorand, some of the smaller coins and tokens. Very much a big, big focus today, Andrew. I'll send things back over to you.
Okay. Dom, thank you for that.
Sure.
Appreciate it. We're going to keep our eyes on a lot of it.
I sent it to you just so I wouldn't ask Dom about the Masters. And all you said was thank you, Dom. You didn't really talk to him. Dom?
I don't need to do Masters. I don't need to do DraftKings.
Is he gone?
Good.
Yes, they're hoping that you'll shut up and move on.
I just wanted one top 10 pick. One top. Put on his mind. Give me your best top 10. Who will finish in the top 10? Give me one guy.
Xander Schauffele.
That's a good one. I got Colin Morikawa.
Yeah, I mean, he's playing with DJ, right, in that first group, or that first day. Anyway,
how about Tiger? Does he finish?
This is what we were trying to prevent.
I know that.
Okay, I will say, I know that producers are going to want to kill me after this.
You don't think people are interested in the Masters tomorrow?
I would say this. I think Tiger, I think that he's taken the last several months to prepare just for this event. I'm a huge Tiger fan, and I'm optimistic that he might even be top 10, maybe even give us some real storylines on Monday.
You know, we have something called the Golf Channel.
It's our sister network, yes. I work with them every once in a while, I kind of do updates for them throughout the course of the day.
You know what you should do? You should actually do a little clinic on there. Dom's clinic.
Nobody wants to see my golf swing. You do, but you're the only one who wants to see my golf swing.
Because I appreciate your transition.
Thank you. Thank you.
So good.
Thanks, Joe.
All right, when we come back, internet pioneer Steve Case will join us to talk Elon Musk joining Twitter's board of directors and what it means for the social media giant. And later, don't miss our exclusive interview with Starwood Capital's Barry Sternlicht on the markets, the Fed, and much more. Interesting timing given where rates are headed. We'll hear all of this from Barry coming up. Stay tuned. You're watching Squawk Box, and this is CNBC. News of Elon Musk joining the Twitter board of directors has rocked the tech world. For a look at how Musk could impact the social media giant and the tech sector in general, let's bring in internet pioneer Steve Case, AOL co-founder and now CEO and chairman of DC-based investment firm Revolution. Steve's upcoming book is due out in September. It's called Rise of the Rest, how entrepreneurs in surprising places are building the new American dream. And Steve, it's good to see you. It's been a while.
Great to be with you.
So let's talk first up about Elon Musk and how he is shaking things up. This idea of him buying 9.2% of Twitter. He's been actively accumulating the stock since January. He's been pretty actively talking about changes he'd like to make to Twitter on the platform itself. What do you think of the strategy, bringing him inside the tent? Is that the right thing to do?
I think it's probably the right thing to do for the company. I'm amazed. Elon obviously is one of America's greatest innovators, running two very significant public companies, but also has time to be kind of an activist investor, now board member of Twitter. Obviously, he's passionate about Twitter. He's one of the most active users, 80 million followers, has strong viewpoints on it. So the fact that he put his money down and bought nearly 10% of the company and joined the board shows a real commitment to Twitter and the platform.
Probably not looking at this as a typical activist investor, somebody who wants to make a little money. My guess is that this is something where he really wants to make a change in how the social discourse takes place and how Twitter treats people, how it allows, what kind of public speech it is allowing on the platform. You've been in a position of having the social platform where everybody was communicating. And it's tough. You've got a lot of people focusing on you. You've got a lot of regulators focusing on you and lawmakers. How do you win in this environment? What's the right way to kind of take Twitter at this point? Because while you may want free speech and you may want things to be there, some of that free speech can also scare away advertisers.
Yeah, no, it's complicated. When I was running AOL, as you mentioned, over 25 years ago, when AOL was the leading internet service, about half all internet traffic went through AOL. We had to deal with a lot of these issues. That's actually when Congress passed some legislation, that what's known as the 230 rules around this. But back then it was a little bit different because people really were posting things in message boards or typing messages into chat rooms. Now, because of the way all the social media platforms use algorithms to bubble up content, different people see different things based on their previous kind of habits. It is a little bit different. The platforms are playing a little bit more of the role, essentially, of publishers. So it gets a little bit trickier. I think Elon is passionate about this, and I'm sure will bring his views to bear. He's already done that by tweeting about it. Now he'll be able to play a role by sitting at the boardroom table. I think he will recognize quickly, though, there is a difference between being CEO of a company and being a board member of a company.
Yeah, although he's got almost 10% ownership in the company, and he's got the means to back up if he wants to buy more. I mean, maybe they limit him to 14.9%.
Yeah, they have limited him, yeah.
But, I just feel like he is a major influencer and is probably going to have a little bit more sway than the average board member might have.
Oh, sure. No question. But my point is that when you're CEO of a company, particularly companies that are founder-led, like both Tesla and SpaceX, you have quite a bit of flexibility to decide what to do, and the boards generally kind of go along with it. When companies like Twitter, there's a broader kind of array of people at the boardroom table and a different kind of approach to governance. So I think it'll just take an adjustment. But I think it really does show, as you said, a real commitment to Twitter, a belief that Twitter is an important platform in the world and wants to invest in it and try to innovate around it.
Just touching back on your experience, going through this, having Congress really taking aim at you because you were the biggest platform out there, the biggest internet platform at AOL. Is it worth the headache? Is it worth the hassle?
Of course. I mean, these platforms are important to the world. They're also very, very significant businesses. And with overseeing a platform like that, you have a broader set of constituencies and responsibilities, including Congress. I was at the Congress, the U.S. Capitol yesterday. It happened to be the 10-year anniversary of the Jobs Act being signed into law, and spent some time with a number of folks there. And they are focused on these issues. They recognize they have a role to play as well.
Hey, Steve, we've been talking for the past 2 days since this happened about the implication or exposure potentially for Tesla shareholders or shareholders of SpaceX or his other businesses. I always admired what Jeff Bezos did in terms of buying the Washington Post and rebuilding that franchise. At the same time, I don't know if I would be happy as an Amazon shareholder that he went off and did that. How do you think shareholders of Elon Musk's other companies should think about this, given the political implications? And by the way, the fact that in the SpaceX case in particular, actually both cases, there are huge sort of policy implications, and actually the government in certain cases are buyers of some of those products.
I think it's tricky. Obviously, as you mentioned, some of it is around the time commitment. How many things can a CEO do? And if you're CEO of two very significant public companies, that creates more of a challenge. But I think people recognize that Elon has a lot of energy, has a lot of ideas, and has been doing things beyond those two companies over the last several years. But then you do raise an interesting point that when you move into this world, as Jeff Bezos found with the Washington Post, including with President Trump, you do become more of a target. So that there is some risk associated with moving into the world of media influence. And so that people have to wrestle with that aspect as well. Now, again, Elon has been doing a lot of that over the last couple of years. This is stepping up his activities, but it's not like he's been silent previously and suddenly he's going to be engaged.
Hey, Steve, real quickly, Rise of the Rest. I mean, we'll have you on again to talk about this book before it's out. But the movement that you have been talking about for years at this point got super juiced by the pandemic, just by the idea that you don't have to be in Silicon Valley to be running a tech company at this point. You can have talent anywhere, and that talent can live just about anywhere. This has to be the thing that you've been kind of hoping for and predicting for a long time.
Yeah, I've been working on it for nearly a decade and traveling around the country. As you know, we've talked about it with our bus tours, and it's really been fascinating to meet entrepreneurs and see what's happening in different communities. I decided really the story needed to be told, which is why I wrote the book, which is this we're announcing today, and it'll be coming out in September. It's amazing stories about entrepreneurs, many companies you've never heard of, building companies in places that most people don't think of in terms of being startup cities, and it's really quite remarkable. It's sort of an untold story of America. I think hopefully an optimistic view of the future of America, because it's not just innovation happening in a few places like Silicon Valley, but happening in dozens of different cities. And you said the pandemic really has been this shake the snow globe moment, accelerating the dispersion of talent, the dispersion of capital, giving more of these cities a sense of possibility. So I think it's a very exciting time. I think maybe even can help unite in at least a small way a very divided country, because part of the challenge we face is a lot of people in a lot of places are feeling kind of left out and left behind. But the entrepreneurs are moving into the epicenter and really playing a significant role building great companies in places like Temper Pack in Richmond, Virginia, or Tempest in Chicago, or StockX in Detroit, or Stored in Atlanta, or Neighbor in Salt Lake City. I could give you dozens of other examples. They're all in the book. So I look forward to having the book come out and telling these stories of these entrepreneurs, of these cities, and of I think an optimistic view of the future of our nation.
Hey, Steve, do you talk to JD Vance still? I know you've had him on.
I have not talked to JD in quite a while. I know he's busily working and running for office in Ohio in what is a somewhat controversial race.
Yes.
So I think, but I've stayed out of that. As you know, my view has always been, which part of the reason I was able to work on the Jobs Act 10 years ago and do some work now on innovation policy, is I kind of stay out of politics, focus on policy.
Right, and it's great stuff to take some innovation to where maybe you don't think of Middletown, Ohio, or something. That I think that's where he's from, and to make equal opportunity. You're not just on the two coasts for all of these
and you also can reduce the brain drain. A lot of people in the different parts of the country do leave because there is an opportunity there, and they often go to the coast. So how do you slow that brain drain of people leaving and create a boomerang of people returning? And if you have some examples, some tentpole companies that are successful, you have more venture capital, you have more people in the community rallying for those entrepreneurs, then you can start seeing those cities rise up. And that's what we've watched play out over the last decade. It clearly has accelerated because of the pandemic, as Becky said. And now that we're separating kind of work and life, people have more flexibility in terms of how they work and where they work and how they live and where they live. That, I think, will accelerate this whole rise of the rest phenomenon. So I really look forward to having the book come out in September and being able to travel the country and really celebrate what's happening all across the country.
And Steve, we look forward to hearing more about it before then. Thanks for joining us today. It's good to see you.
Thank you all.
Good shot of his office there.
It is. It's nice. Might have been a background. Coming up, your morning headlines, and I think he's got probably palm trees in Kauai behind. I don't know where. He's on Maui, I think. Check on the mortgage market, or has a place there. He probably isn't there now. Plus, Starwood Capital's Barry Sternlicht talks markets, real estate, labor, supply chain issues, and much more. Was it Lanai? He owns something. Squawk Box are coming right back. Yes.
Welcome back to Squawk Box this morning, live from Times Square at the NASDAQ market set. Here is what is making headlines right now. Treasury yields, they're holding near their highest level in about 3 years. It follows hawkish comments by Fed Governor Lael Brainerd yesterday suggesting the central bank would move more aggressively in how fast it raises benchmark interest rates. Those comments coming ahead of today's release of meeting minutes, I should say, from the most recent Fed policy meeting. That'll come at 2 p.m. Eastern time. A lot of folks are going to be watching that. And Deutsche Bank putting out a note saying they think a recession is on its way. Goldman Sachs, too, by the way. The Biden administration set to extend the suspension of federal student loan payments. An announcement on that expected today as well. It'll extend that moratorium until the end of August. Now, the suspension's been in place since mid-March back in 2020 when the pandemic began. It's currently scheduled to expire on May 1st. President Biden set to sign a bill today that will give the U.S. Postal Service about $50 billion in financial relief over the next decade. As part of that relief, future retirees will be required to enroll in government health insurance. That would change longstanding rules that require the service to fund 75 years of retiree health benefits in advance. Part of the problem with the post office has really been an accounting issue more than anything else. Quick check on the futures. Let's show you right now where things stand. We are looking to open down. Dow off about 206 points, NASDAQ off 210 points, S&P 500 off about 40 points. We're right back after this.
Time now for today's AFLAC trivia question. What 3 countries were the top 3 oil producers in 2020? The answer when CNBC Squawk Box continues. Now the answer to today's AFLAC trivia question. What 3 countries were the top 3 oil producers in 2020? The answer, the United States, Russia, and Saudi Arabia. Combined, these countries accounted for 43% of the world's liquid petroleum products.
As still want to know what order. I think it would be Saudi Arabia, United States, Russia, but I don't know for sure. In the meantime, mortgage rates now topping 5% as the spring home buying season starts to take off. Diana Olick joins us with the latest report on mortgage applications. And Diana, what's the numbers?
Well, here's a scary number for you, Becky. Total mortgage demand is now 41% lower than it was a year ago. That, according to the Mortgage Bankers Association, and that is what fast rising mortgage rates are doing to the market. The average rate on the 30-year fix for conforming loans jumped from 4.8 to 4.9% last week for loans with 20% down. That's the weekly average from the MBA. But yesterday it crossed 5% according to Mortgage News Daily, which obviously runs the rate daily. Now, that's both a financial and an emotional line crossed. Higher rates caused refinance demand to drop 10% last week, now down a stunning 62% from a year ago. That's the lowest level since the spring of 2019. Refis were half the market a year ago, now barely 39% of it. Mortgage applications to buy a home fell 3% for the week and were 9% lower than the same week one year ago. A strong job market is keeping the fire under buyer demand, but the supply of homes for sale still very tight. The average loan size to buy a home, it just keeps rising because home prices are up 20% from a year ago, and FHA demand, which is generally your first-time buyers, is dropping very hard. Becky?
And Diana, I think this gets to the heart of it. We've been trying to figure out when home prices will actually come down. Part of it's going to be the mortgage costs going up, and that cuts into things. But your point of the supply being maybe the biggest question. If it's still more expensive to rent, rents are going up, what does eventually bring the cost of homes down, and when do you see that happening?
Well, generally, prices lag sales by about 6 months, and we've seen pending home sales, that is, signed contracts on existing homes, come down for about 4 months. So you would expect to see prices start to ease soon. We still haven't seen it yet, though. Those annual gains just keep getting bigger. Another question is new construction. We are starting to see supply in the new construction market increase. So do builders start bringing their prices down a little bit? Well, they're still up against high costs for land, labor, materials. So that's a big question mark as well. But another component is with these higher mortgage rates, a lot of people are no longer qualifying for a mortgage. If they can't qualify, they can't buy, and sales come down. Again, it all depends on how tough this spring market is for those first-time buyers and how much demand there is in the new construction market. Becky?
Diana, we're going to need to hear a lot more from you. This is an important inflection point. Good to see you.
Sure.
Still to come, our exclusive interview with Starwood Capital's Barry Sternlicht on so much, on the markets, the Fed, much more. Plus, the latest out of Washington with Senator Roy Blunt. As we head to break, here's a quick check on the markets. And see, we are down significantly, especially in the NASDAQ. Rates are going higher, I guess. Stay tuned. Squawk Box will be right back. get right to the markets, the Fed, and more with our big guest of the hour. Oh, boy. High expectations for Barry Sternlicht, Starwood Capital Chairman and CEO. Has never disappointed in the past, I dare say, Barry.
Good morning, Joe. How are you?
I'm good. Let me just describe things, and then you tell me whether this is true or not. So, a lot of inflation, a lot of worries about interest rates, geopolitical concerns, just a lot happening. But would you say it's almost impossible to get a room or very difficult to get an open seat on an airplane? I mean, things are great with all those other things as the backdrop. Is that because of all the pent-up demand as we come out of the pandemic, Barry?
Yeah, I mean, the hotels, particularly resort hotels where you're hanging out, the golf resorts, they're full. And they're charging whatever they want. The consumer coming out of this slowdown is not price sensitive. It's a very unusual recovery, and people can charge whatever they want, luxury goods, whether it's wine or exclusive travel. I mean, it has been you saw the numbers out of the cruise industry the other day. There's definitely pent up demand, and I'm actually astonished at the pace and rates that hotels are able to charge right now. And that's not true of all hotels. Obviously, domestic travel hotels are better than ones that still rely on international travel, which has not really rebounded. But it is really something. I mean, in LA, New York, Miami's up 36% year over year. I would have thought Miami might have been down when the ski resorts in the Caribbean reopened, but no, it's still booming. And planes are full. People have time. Obviously, people are not yet fully back in the office, and that is also a kind of a U.S. thing. That is different around the world, but it is the generation that doesn't want to come in, that wants to work from Jackson Hole. That's sort of a New York, and L.A., San Francisco.
Well,
the rest of the country is coming back.
Were you implying that and we used the word inelastic for demand earlier in the show, are you implying that the demand is inelastic just at the high end, or let's say even at supermarkets?
No.
I think
across. Look, the we're getting. People are upset about inflation. There's good inflation and bad inflation. Everyone, I think, wanted wages to rise for those in the middle class and the lower end of the economic spectrum. So we should be delighted with a 3.6 unemployment rate, and we should be really happy. By the way, one of the problems that you're seeing is we still can't find laborers. There still isn't enough workers, and everything in the country is driven by costs, right? Costs are being driven by wages, and that's actually good. The Democrats and the Republicans, I think, should be pretty happy. What we don't like are these supply bottlenecks and supply chain constraints that are driving, whether it's oil, petroleum-based products. I mean, you're going to see continued inflation. And obviously, I was on the show probably a year ago and said the Fed was way behind. They are way behind, and now they might overdo it.
Well, that's what sort of what I was getting to, was that if the supply stays where it is and the demand is inelastic across the board, basically, because people are flush and they want to go out because of the pandemic, then I don't know how far the Fed needs to go then, because the Fed's job is going to be harder if the higher rates, going up a quarter point at a time from such low rates. How do they get that to where it bites, to where it changes people's behavior, to where you slow down demand, if demand is inelastic right now?
I think people are going to return to a more normal way of living. So I don't think they are totally price inelastic. Part of it is a party atmosphere coming out of the pandemic and just traveling, getting that trip and seeing your family, traveling with friends. I think companies are booking again for groups, although it's still not a big part of the hotel market. It will come back as companies come back, and it's no longer politically incorrect to have a meeting. Yes, the Fed is going to have a challenge because I think the economy is slowing. I mean, deglobalization is real. Imports from China are really, so the import numbers. I mean, we're buying everything, and it's all sitting in containers, and warehouses are full. There's a lot of problems in the supply chain. And if you're building a building, whether it's an office building, a hotel, an apartment building, if you can't find the curtain wall, you can't get the toilets, you can't complete your project. So what that means is, and then interest rates are rising. So costs are rising rapidly. Construction costs are up 10 to 30% year over year. So you either have to charge more to make it economic, or you're going to stop construction because nobody's going to pay you. And I think it's going to sort itself out. The Fed should be careful here because while I think they should do the 50 bips and probably get LIBOR to 1.25, you're not going to stop this problem we have. It's just going to take time for the chain to sort itself out and for the economy to sort of catch up to the bubble of demand that was thrown into into the supply chain by everybody, not only ordering but over ordering. A lot of what you hear is that people ordered too much stuff, and there's no place for it. It's not it didn't get to the store. It's whether it's in the rail yards or the yards outside LA in the water on tankers. But it is getting slightly better. But don't forget, there's another piece of stimulus coming. There's a $1.2 trillion infrastructure bill. And they really haven't started spending that. They also haven't spent much of the money of the America's Recovery Act, the $400 billion that went to the states. Some of that money hasn't even gotten into their hands yet. So if they start building roads, bridges, and tunnels, and we kind of wanted to do the airports and fix stuff up, it's going to continue to put huge cost pressures on everything that is involved in real estate and construction. And where are they going to find the laborers? It's an interesting world. I was at Harvard Business School. I was speaking a week ago Monday, and I looked around the room. There's flags of 40 nations, 50 nations around the room, and you applaud the diversity of the class. And then I think how idiotic our policy is that we don't even let these people stay here anymore. Now we basically kick them out of the country. They can't get visas. I can't hire them. And they go to companies to compete with our companies. I mean, we have some really ridiculous policies, and it is somebody in Washington has to fix the easy things because there's so many easy things to fix that would make this so much better.
Immigration policy being one of them. Barry, I want to go back to the Fed and just your ideas about what a difficult place this is right now. Everybody has said the Fed is behind the curve. They should have started doing this sooner. You just said 50 basis points this time around. Deutsche Bank has a note out today saying they are now predicting 50 basis points this time, 50 basis points the next time, 50 basis points the meeting after that. And as a result, they think that we will be in a recession by next year. They're looking at next summer, stock prices being down 20%. They're looking at unemplation jumping back to, 4.9% from the 3.6% we just clocked. They're looking at a hard landing. They don't think the Fed's going to do this the right way. What is right? If they were to do 50 basis points at this point, then what? Would you say 25 basis points, slow down?
They didn't get it right on the way up. I don't know whether they get it right on the way down. I mean, I do think we're going to have a significant slowdown in third and fourth quarter, particularly the fourth quarter. There's, there's different parts of the economy. The consumer's probably going to get tired. He's kind of bought everything he needed to buy. He bought his couch. He bought his new desk. He bought a new computer. He bought a phone. So I do think the economy is going to slow somewhat materially. These price increases can't keep up. But again, inflation driven by wages is kind of a really good thing. We wanted this. And there'll be productivity and investments. There's so much bad news, bad karma, whatever it is, spirit out of Washington. The whole discussion of tax rates, which we should talk about, and how the 1% aren't paying their fair share and corporations are paying zero. I just wish politicians would tell us something remotely resembling the truth. Like we have investments. We have an energy renewables business. We rely on companies buying tax credits to invest in the renewables, which is what the Democrats want to see happen. And that's driving corporate tax rates down. And they buy this stuff, and it's what they want.
Barry, on the tax front, as you know, I'm not a big fan of taxing unrealized gains or anything like that. But we've long talked about it. And by the way, you're a beneficiary of it. Carried interest is something that, you don't pay and I effectively do, or the opposite, if you will. Same is true of the real estate issues and the sort of benefits that incentives that we've given the real estate industry for quite some time. You can go down the list. Are there things within that category that you would be in favor of working on?
Yeah, I think the 1031 exchanges they could get rid of. I don't see why real estate should be passed tax-free when the stock can't be. I don't really understand that. It's a lovely thing, I guess, but it's not when you're trying to raise capital. That's a lovely thing or something you don't really need. I do think, Andrew, I pay a 34% tax rate. I just checked. And I knew I'd be on, so I wanted to know.
Is
And
that federal, or does that include state and local?
No, that's federal. I'm now a taxpayer in Florida, so it's federal. And by the way, Florida makes up for their low income taxes with pretty high real estate taxes. And Andrew, when you go after commercial real estate or the complex, right? What we do is our values are our buildings support the cities, the schools, we pay the property taxes, which fund the police, fire, life safety.
Right.
So you can tax these things and they will drop in value, and it will affect the payrolls and the municipalities and the staffing of what we call services. So I don't think real estate is an asset class. I always tell my people that they're always going to take the brunt because buildings don't vote, people do. So they're always coming after municipalities.
Right.
State and local governments always come after real estate.
Barry, would you not do what you do if you didn't get the carried interest benefit?
Well, the carried interest is really a delayed tax, right? It's just capital gains. We pay capital gains because we invest, right? And then, like any other investment, we invest. Would I not do it? I don't know. I haven't had.
What do you mean it's a delay? It's not. There's nothing. You're paying a lower. You're paying a lower rate, effectively on income.
Yes.
Than I'm paying.
Well, it's not income. Andrew.
Well, and that's what we have to decide.
On management fees, we pay hold on. On management fees, we pay ordinary income taxes. On investments, like investments that you make in your house, when you sell your house, if it's not your primary residence, you pay capital gains.
If you put your own money into your fund, you should absolutely pay capital gains rates on that money. No question. We're not talking about that. We're talking about, and on your management fee, you pay ordinary income. What I'm saying is the carried interest component, which is a huge component of your income annually, you are paying a capital gains rate on that. I am saying that's a fee that is not actually an investment.
I don't know if that's, I characterize it that way. We are at risk capital, and it is.
But by the way, the real estate agent, Barry, the real estate
stocks, Andrew, it goes up and down, right? So you have an
Barry, the real estate agent who spends 2 years trying to sell a property, his fee is at risk. It's either going to work for him or it's not. The banker who gets a bonus at the end of the year, that's at risk. There's a lot of people who get income annually that's quote unquote at risk. And for some reason, we've decided that that private equity and venture capital is somehow a special class of person who should pay a lower rate. Does that make sense to you?
It's a system. I mean, I don't really have an opinion on it. I don't.
You must have an opinion on it.
Well, I think the system is fine the way it is, honestly. It's not really where I focus. I want to talk about the Democrats' focus on people not paying taxes. I don't know many people who don't pay taxes.
But this is what they're talking about, Barry.
No, but this isn't what they're talking about. This is a tiny piece of the pie. Tiny, right? Individuals invest. Companies.
If we solve this piece, which people look at as so unfair, that you're paying a rate that's different than everybody else at this table and everybody else in America, and you're at the highest end of the country to begin with, they say this doesn't make sense.
Andrew, your party talks about companies stealing from not paying any taxes. Okay? You have the same approach to individuals. Companies drive down tax rates by investing in renewables, in solar tax credits, in all this stuff. They're not cheating. In general, companies are really good corporate citizens. They invest in plant and equipment.
I don't think we should ever blame an individual for not paying taxes or a corporation for not paying taxes when they're following.
Everyone can pay taxes, but there's a policy. The government produces a policy, and they want to support investment behind certain industries, and those are really important. You want to drive renewable investment. That's how tax rates go down. It's not everybody cheating. All you hear about from the Democrats is everyone is cheating.
Barry, you and I are in agreement. I think it's crazy. I think it's when Elizabeth Warren goes after Jeff Bezos or Amazon and says that somehow they're not paying their fair share, they're not paying. That doesn't make sense to me. My view is, who we should blame?
Let's
Washington.
get off of capital gains. Let's talk about the economy. Let's go back to the economy because it's really interesting. Let's talk about housing
now,
for a second.
Actually, so we got to.
I want to talk about housing with you guys.
I was going to ask you, I mean, with the great resignation and everybody at home, on Zoom, how's office space rentals? How are you doing with that?
It's coming back, as you know, but it's coming back pretty hard in places like many of the red states. People are back in the office. Some companies are having a real hard time getting people to come back. And from what I'm hearing we have a big footprint in Europe. I mean, it really is more of a U.S. thing. London's full. The Middle East is full. Asia was full until the recent China issues. So, that will sort itself out. It's going to be a boom for cities like New York. San Francisco's having its own problems. It's probably the worst office market in the country, and will remain that way. The one thing that I think your listeners would like to hear about is really the housing market. And the only thing I'd say, I gave you guys some slides. We really underbuilt housing, and that's driving housing prices, rents, and rents from single-family homes, to double-digit increses. And that's probably an interesting story for real estate.
It's because higher interest rates aren't going to slow that down. Then that's
right.
The thing, Barry. That's why the Fed. That was my initial point. That the Fed's going to have trouble. I don't know what the Fed uses to cut down inflation when there's supply chain issues.
This is a chart of rent increases right now you're seeing in the country. That is single family for rent.
Is that year over year? That's
year over year, and that's 10%. And this be I can't see the heading, but that's multifamily, and one is single family.
Multifamily.
I mean that understates it. That's actually probably 60% of it, because you're renewing the guys in place at 10%, and the market rents are up 20%.
All right.
So that's part of CPI, by the way. That's a delay factor in CPI. Guys going to continue going up for a while.
I have to say thank you, and Squawk Box. That's what I just was told. Thank you, and Squawk Box will be right back. That's the way we're ending this.
Thanks, Barry. Welcome back to Squawk. Tech stocks, they are under pressure this morning. Take a look at some of the big NASDAQ 100 laggards. The FANG names all down now more than 1% each. Joining us right now is Elliot Robinson, partner, co-founder, growth investment practice at Bessemer Venture Partners, where he focuses on cloud companies. Elliot, it feels like it's been a bit of a roller coaster. We're now moving in the wrong direction again. There was a period where all of a sudden it seemed like growth was actually going to come back, even though we were worried about inflation. Now we're worried about inflation again, and here we are.
Yeah, that's right. And thanks for having me back. Good morning. So at the firm, we track something we call the Bessemer Emerging Cloud Index, which represents the best cloud software companies on the planet. It's down about 19.5% year to date, despite a bit of recovery in the second half of March, kind of what you are alluding to. And it's something we're now living in that we call Q1 the Sassacre. Now, down 19.5% year to date, that's juxtaposed against the NASDAQ, which is roughly down 10% year to date. And then if you compare it to the Dow or the S&P, which is about 5% down year to date, if you drill into the numbers, average mCloud revenue multiple is hovering around 12.5 times right now. That's down about 40-50% from the peak in Q4 of last year.
So what are we thinking at this point? We're going to hear from the Fed later today. Do you think that all of these stocks are just going to continue to get crushed?
Yeah, I mean, the Fed has basically come out yesterday and said their best weapon against inflation is to raise rates, and we've got to stop inflation. You know, the benchmark that I typically use for cloud software companies right now is Microsoft. It's trading about 10 times next 12-month revenue. That's compared to 12.3 times at the peak in November. Now, if you compare that to our SaaS bucket in the cloud, at the peak it was at 23.9 in November. It's now trading at 13. So that bifurcation between top growth stock companies that we saw in Q4, it's totally shrunk, and we've redefined what growth means. So I think with the Fed saying they're going to continue to raise rates throughout the year, we're going to see those multiples compress. However, the really breakout companies in the cloud, those that are growing 40, 50, 60%, they're still seeing multiples somewhere around 28. So Cloudflare, Snowflake, Bill.com, Zscaler, Datadog, those are the best in class companies, and I think they'll be able to grow through multiple rate increases as well as geopolitical instability in Europe.
So does that mean you're moving money into them, you think there's going to be a real growth rate during this period, or do you sort of sit on the sideline and if you've got money in them already, you just hold?
Yeah, I think there's a certain class of growth stocks that it's worth holding your money in. Again, those that are trading, anywhere from 15 to 20 times, all of those are growing north of 40, 50%, have strong fundamentals, big market opportunities, great unit economics. That's how we look at it. The Bessemer Rule of 40, which combines not only just growth rate, but their ability to generate free cash flow in the future. Before, let's call it 6 months ago, we would have said, put all of your capital in the cloud. And now what I think we're seeing is there's still good, valuable companies in that basket, but we would really target those that are growing 30, 40, 50% and above.
And what do you do with the Microsofts of the world?
Oh, those are great holds. So,
those are great holds,
Azure,
but not great entry point. I guess what I'm trying to figure out is some of these seem to be great holds, but the other question is there any that you say we're at some kind of great entry point even in this moment?
Yeah, I mean, if you look historically, where we are now, somewhere between 12 and 14 times on a valuation and revenue multiple basis, historically over the last decade, that's typically where it's ranged. We're coming out of a peak in November or Q4 of last year. So I think this is actually a good entry point. Again, I would just focus on the companies that have that combination of high growth, profitable or at least break even, and those that have strong fundamentals and a big market opportunity ahead.
Anything you'd short?
I'm a private capital venture capitalist, so I'm still shorting the deals that are getting done in our market in the 50x, 75x, and even sometimes 100x. But in the public markets, I think if you look at the best cloud software companies in the world, it's a decent entry point. And again, as long as you're optimizing for efficiency and growth, I think you'll be in a great stead for the years to come.
Okay, Elliot, we're going to leave the conversation there. It's always nice to see you. Thanks so much.
Thank you. Talk to you soon.
It is just about 8 a.m. in New York, and you're watching Squawk Box live from the NASDAQ market site in Times Square. I'm Andrew Ross Sorkin, along with Joe Kernan and Becky Quick. Take a look at futures right now. We've got some red on the screen as continues, or I was going to say worries continue about inflation and potentially even a recession. We'll talk about what Deutsche Bank was saying earlier. Dow off about 232 points this morning. You look at the NASDAQ off. We're showing percentages now. That means actually that's when actually we get to one of those points where it's big enough. NASDAQ off about 1.5%, a little bit more than that now. S&P 500 off about 1%.
All right, let's get to Dom Chu with this morning's pre-market movers. Dom, and keep in mind, you are tossing back to me this time.
So I'm going to save the conversations and the nuggets I have about
All
Augusta
right, good.
National
I have a good one, too.
until the end of this. All right,
I have
so
a good one.
okay, so let's get through the business first. The morning movers. Let's take a look first of all at one of the big earnings movers so far this morning. This is cannabis producer Tilray. It's coming up right now, up 2.5% in the pre-market trade. It comes out and reports a surprise profit, even though revenues came in shy of analyst consensus estimates. It also announced a distribution partnership for one of its subsidiaries with Whole Foods, which is, of course, a subsidiary of Amazon, to sell some of their hemp products in Whole Foods, certain Whole Foods locations. All of that on balance has led to a 2.5% gain for Tilray. But again, as you can see, marijuana cannabis companies have not had a good time over the course of the longer term period over the last year. We've lost 2/3 of our value on Tilray brand. So watch that one. Also watching what's happening with the update on M&A talk. And this time it's from that unsolicited bid by JetBlue to jump in and try to buy Spirit Airlines. JetBlue wants to offer $3.6 billion in cash to buy Spirit Airlines. They had an agreement to be acquired by Frontier Group Holdings. So there's this drama playing out, but all three of those are down in the pre-market trade right now. But reminder, Frontier's deal was a cash and stock offer for $2.9 billion. So we'll see how they're going to do it. Spirit Airlines says that their board is evaluating that proposal. And then a check on the most popular tickers, search on our website, cnbc.com, from yesterday's full session. Maybe no surprise. The 10-year yield is still up there. The 2-year yield is. The 10-year, 2-year Treasury spread is still within the top 10. But WTI crude slips a little bit down that list. Twitter, Tesla, and Apple. Tesla and Apple perennial on that list. Twitter, of course, on that list because Elon Musk is now a big stakeholder, a board member. He is, by the way, amended his filing on his ownership stake in the company to be not passive anymore. Maybe not surprising there. He's a little bit more active on the board. Anyway, check those out. The rest of the top 10, highlights from the top 50, as always, Joe, on my Twitter feed, @TheDomino on Twitter. I'll send things back over to you now.
Excellent. Real quick. So
Okay.
John Rahm's favored. You saw that.
So is
He's,
Justin Thomas, yep.
And
They're
Justin Thomas,
tied.
a little,
Yep.
not quite. Tiger is still in like the top 17 guys. But if you bet $5 on Tiger and he wins, you would win $205.
All right, so you know us folks over at NBC Universal, we have a partnership with this company called PointsBet, right? And they'll feed a lot of the data that goes into Golf Channel with regard to the odds and that sort of thing. So I was just on PointsBet USA this morning. A few days ago, before the Tiger headlines came out, he was already plus 8,000, right? 80 to 1-ish, we'll call it that, right? Now he's plus 4,000 to 5,000. So a lot of that money's moved that way, even though most of the money, the handle, so to speak, was already being put on Tiger. He's now moved the line significantly, given his announcement.
Even when less than a year ago we thought he'd never, much less walk, but very well, or play again. Amazing. Scotty Scheffler.
Scotty Scheffler's in the top 10 right now. So is Rory, and so is Victor Hovland, though. I would put Victor Hovland's been a hot hand these days, too. So from a betting perspective, you and I like the numbers, Joe, and it's always fun to see the odds kind of move in real time as people start to kind of put that money towards them.
The bad news is that the 7 o'clock guy is still in my ear at 8:03, which I wasn't counting on. All right.
He's in my ear now, too.
I'm
being
in the
told
7
to move
o'clock
on.
rundown.
Yes.
Well, we do that now.
Shut
We do that. No, we do that now. We go through it. It was earlier today. We were at 4 or 5 after.
9.
Yeah.
9, I was watching.
Yeah. All right.
Anyway, the markets will be looking for more clues from the Fed today with the release of the minutes from the latest meeting. Steve Leisman joins us right now with some of those expectations. Hey, Steve.
Hey, Becky. Yeah, big day. Markets bracing for the release of the minutes of the Fed's March meeting, which should provide new details about plans to reduce the balance sheet. The minutes coming a day after Fed Governor Lael Brainerd prompted a sell-off in bonds and stocks with a warning that those plans are likely to be very aggressive. Brainerd said that the balance sheet runoff could begin and be approved as soon as May, the May meeting in early May. It would be a rapid pace of a runoff, and there would be large caps or limits on the runoffs, which would allow them to run off a lot every month. The Fed during the pandemic, more than doubling the size of its balance sheet to $9 trillion in response to the pandemic. It brought large amounts of treasuries and mortgages in an effort to stimulate the economy, further driving down interest rates after, of course, it had already cut Fed rates to zero. Calls for an aggressive wind down amounts to a really sharp policy reversal. The Fed had been buying bonds up until last month. Now, the Fed's no longer going to replace bonds and mortgages that mature, allowing them to so-called run off. Brainard's comments about a rapid pace of runoff as something in the Fed could reduce the balance sheet by as much as $100 billion a month, or double the pace of the last runoff in 2017. Causes some concern. Krishna Guha, Evercore ISI, writes, we do worry about the Fed being too aggressive with QT, or quantitative tightening, into a bond market that is subject to war-related volatility and potential future stress. Anywhere from $45 billion to more than $100 billion of treasuries will run off each month naturally. Mizuho believes the Fed will let up to $65 billion of treasuries go away each month and $35 billion of mortgages. The effect on the bond market, though, is going to be determined by the Treasury. They have to replace or fund in the public markets what the Fed is letting roll off. But the market's already figured this out. It all means higher interest rates, and that's going to challenge stock valuations. Becky?
Steve, it's kind of amazing. In the span of a couple of days, we've gone from the Fed is way behind the curve to, oh my gosh, they're going to do too much.
Yeah, we're definitely going back and forth. It's a little weird, Becky. I had been planning to do a story this morning before I knew what Brainard was going to say or figured out what she said, about whether the market was paying attention to what we've been saying and the expectations of people who follow the Fed are. And I just want to show you very quickly from our Fed survey what the expectations were. We had been for many months chronicling an expectation of $70 to $80 billion of runoff a month, 540 in 22, 900 in 2023, 1.2 in 2024, for about 2.7, 2.8 trillion total over about 3 years. I don't know. This number today could be closer to 80, could be closer to 90 or 100. But it seemed a little bit like yesterday, Brainard kind of slapped the market and said, hey, you guys, wake up. We're going to be reducing the balance sheet. And now that's on. And some people, I think, may not have been paying close attention to this.
Yeah, and the rapid kind of wake-up call that came with Deutsche Bank saying they expect a recession now. They think stocks will be down by 20% by next year. And this commentary that we kind of run through the morning, this idea that the Fed's tools are not the right ones to fix the problem. What's causing inflation is in part demand, and they can tamp demand down. But it's the supply chain, too, and they have zero power to fix the supply chain.
I mean, I think it's a combination of things. I think the supply chain is a piece of it. But there was definitely a lot of fiscal stimulus out there. There was definitely a lot of Federal Reserve or monetary stimulus out there. There is no doubt that the Federal Reserve should be withdrawing stimulus, and it should have done so quite a while ago. It's kind of, I don't know what to say, but ridiculous that last month it was still buying bonds, and now it has to talk about an aggressive wind down. That's a very sharp policy reversal that suggests, you know, in so many words, the admission of a mistake.
It is. And Barry Sternlicht just pointed out that you've got more infrastructure spending coming to the tune of $1.2 trillion, so the fiscal spending's not going away. Steve, thank you. Great to talk to you. We will see you later.
Sure.
When we come back, Senator Roy Blunt will join us to talk about the latest out of Washington on another round of Russian sanctions. Plus, JetBlue making an offer to merge with Spirit Airlines, which could upset the prior merger plans between Spirit and Frontier Airlines. None of the stocks reacting that well to this today. Spirit down by 3%, JetBlue off by 3.33%. We'll have the latest on the bidding war. Stay tuned. Squawk Box will be right back.
Welcome back to Squawk Box this morning. The futures are in the red this morning. NASDAQ looking to open down about 234 points right now. The Dow off about 242 points, and the S&P 500 off about 43 points. Becky.
In the meantime, the U.S. is set to announce new sanctions on Russia today in coordination with the Group of 7 advanced economies and the European Union. The White House says Russian banks and new investments in the country will be targeted. Also, as Russia's war in Ukraine reaches 6 weeks, the head of the EU executive said that today the bloc will probably target imports of Russian oil. All of this comes as evidence has emerged of killings and torture in a town outside Ukraine's capital of Kyiv. Also, as apparent widespread killing of civilians nearby. Joining us right now to talk about further sanctions on Vladimir Putin's economy is Senator Roy Blunt of Missouri. He chairs the Republican Policy Committee. And Senator Blunt, thank you for being here today. Let's start with this, just the atrocities that we are seeing uncovered here. Will these sanctions continue to ratchet up pressure? Will they do anything?
Well, I hope they do. I do think the one thing that won't do anything, frankly, is this idea that somehow Putin is going to be shamed into changing his policies by a UN investigation to the World Court. You know, clearly the World Court of Public Opinion is beginning to understand just how Putin has acted, the wealth he's taken away from the Russian people, and now what he's doing in Ukraine. Did the same thing in Syria, did the same thing in Chechnya, brutal, aggressive, focusing on innocent civilians, hospitals, schools, buildings that they know children are in. It's unbelievable. But what you see in these, as we now recapture, as Ukrainians recapture territory, is mass graves, people with their hands tied behind their backs, shot in the head, that are civilians of all ages, all walks of life. It's just unreasonable, and I think we're going to see the rest of the world respond. Europe apparently now prepared to move forward with more oil sanctions, more coal sanctions, trying to deal with the difficult issue that Germany, frankly, got themselves into of being so dependent on Russian natural gas. But Russia has branded itself for who it is under Putin, and they're not going to be able to run away from that, Becky, I don't think.
Yeah, I don't think so either. I mean, these sanctions are having an impact, at least on the Russian people. We've been hearing about how inflation in Russia is up 15% in very short order since this war's begun. These additional sanctions certainly will eat in, but does it impact Putin? I mean, he has shown a very high tolerance for pain on his people in the past.
Well, he certainly has a high tolerance for pain on the Russian people. You know, what the Russian people have had stolen from them by Putin and the oligarchs, the inability to have that last ability for over the whole history of Russia to really have the personal freedom they'd like to have, and the personal freedom the Ukrainians are fighting to be sure they can hold on to. You know, they have been subjugated by Russia before. They don't want that to happen again. I think the surprises of the incredible Ukrainian resistance, the poor performance of the Russian military, and NATO coming back really to be prepared to serve its own purposes of defending the NATO countries, and now looking at a neighboring country and doing what they can to help that neighboring country defend itself. Pretty incredible, unanticipated. I think it's going to have big long-term economic consequences, big long-term military consequences as to how we look at military assets, as well as be a big part of the future energy discussion.
A story we have not discussed this morning, one that came out from Reuters, but I think could be key and maybe the most hopeful thing I've seen to date. 6 people told Reuters that some of the Chinese state refiners, we're talking Sinopec, CNOOC, PetroChina, and Sinochem, that they are shying away from new contracts for Russian oil, that they are honoring the contracts that go through May, but they are not buying beyond that, because they are concerned, as Beijing has warned, that these sanctions could have an impact, and you don't want to be tainted with that. Even though they're being offered very low prices for oil, maybe this is the turning sign. Maybe this is a point where China stands up and says no, and if Putin loses Xi as a partner, maybe that actually makes a difference.
Well, it'll be interesting to see how that long-term irrevocable relationship, or whatever they announced just a few weeks ago last. They've never had a good long-term relationship. China certainly will drive a hard bargain when it comes to buying energy and other things from Russia, and they should be concerned about being tainted by what's happening right now in Ukraine. Again, the world's looking at this, understands what they see, and they'll understand who the partners are, and they'll understand who's helping Russia evade sanctions. Those sanctions will get tougher. The Congress needs to come up with its own sanctions so they're actually law rather than done by the president. And the big hang-up on that appears to be what kind of waiver authority the White House is going to continue to insist on. I think Russia's going to pay the price here for a long time, and China shouldn't want to pay that price along with their new closely bonded ally of Russia. It was a big mistake for China to make that commitment without knowing what Putin was going to do, and an even bigger mistake if they did know what Putin was going to do.
All right, let's get back to inflation here in the United States. Today, there is a hearing that's taking place in Congress where they are going to be calling the heads of the major oil companies up to find out why they are price gouging at the pump. What happened there? I mean, is this price gouging to see prices increase like this, or is this a result of what's happened on the oil markets, what we've seen with just higher prices across the board as the economy reopens after COVID and the Ukrainian war?
Well, I think it's clearly, the basis for it is clearly the Biden energy policies. The policies he announced during the campaign. Energy prices began to go up not the day after the inauguration. They went up the day after the election as people anticipated what would happen if Biden's energy policies became the energy policies of our government. I think by Christmas, Christmas Day, gasoline at the pump was the highest it had ever been. And it had gone up $1.15 a gallon on average before anything happened in Ukraine. These energy policies produced exactly what they would want to produce. In fact, Democrats say we want to drive people away from using fossil fuels. And then Governor Newsom in California, I think this week, said we're thinking about giving subsidies, checks to help people who have cars. It's their own policies would produce the result that they would say they would want them to produce to drive people away from using our traditional energy resources. And then they come up with goofy things like reducing the strategic oil preserve or giving people subsidies to try to offset the inflation, a lot of which is driven by rising energy prices, and the rest, of course, driven by demand. A lot of that in that $1.9 trillion package that Democrats and only Democrats voted for in March to send money directly to people. People wind up, when they get money, they wind up spending money. And if you put that much more money in the economy, that's also going to drive inflation. It's clearly the number one economic and political issue in the country today, and still will be by this time in November.
Senator, I wanted to ask you about a different issue that relates to the supply chain, which is labor and COVID. Politico describes you as the Senate's top GOP healthcare appropriator, and you have advocated effectively against spending more money, the original package that the Biden administration had put forth, and recently said you think that the Biden administration is going to have to actually come back in 60, 90 days to get even more money. Why not come up with a package today that makes sense if this conversation is going to have to happen all over again in 3 months?
Well, you'd have to ask the Biden administration that. I think, Andrew, this package has gone. One time they said we might need $90 billion, and then they actually publicly suggested they were about to ask for 30, and then they asked for 22, and then they asked for 15, and now down to 10. That we'll probably have to go back and look at this again. I've never understood why this request came the way it did or ratcheted down constantly. Clearly, I think the accounts that they use for therapeutics, for vaccines, for testing, for research have been spent down. I'm for trying to do what we can to restore those accounts, but you certainly can't restore them more than the administration is asking for. And this idea that we're going to repeal Title 42, which is the COVID restriction at the border, but we still need billions more COVID dollars here. really significantly complicated getting this done and probably prevents it from getting done this week.
So what do you think the fair number is that's going to be needed by the time that, if we had this conversation at Christmas time, 2022?
I think the fair number, it's hard to know the fair number without knowing what happens in COVID, but I think 10 billion is a minimal number to see how far that gets us. That's what the administration is asking for domestically. I'd like to do it. I think we were really close to being able to get that done, and then CDC announced the change in their view of the impact of COVID. And frankly, that's all some of our members needed to decide, well, we're not going to deal with the COVID issue on spending unless we have a chance to talk about the COVID issue at the border. So if anybody ever wondered if CDC was politically motivated, this would suggest they're politically tone deaf to put that statement out at the same time we're trying to increase by several $1 billion the COVID spending numbers. And they have spent the money. They've spent it in the categories. Another part of that problem is there's a lot of money in the so-called COVID recovery bill that hasn't been spent, and only about 6% of that $1.9 trillion had anything to do with actual COVID treatment. The rest of it was to drive an economic recovery in an economy that was already obviously well on the way to recovery.
Senator Blunt, want to thank you for your time today.
Hey, great to be with both of you. Good to see you soon.
I'm here too. Missouri, show me state, Missouri.
Joe, good to be with you too, Joe.
Good to be with you, Senator. Thanks for, hope to see you again. Coming up, what the CEO of the nation's largest public pension fund is watching in the markets. Marcy Frost from CalPERS will join us for an exclusive interview. Plus, America's top oil executives face a key House committee today with gas prices still near record highs. We'll tell you what you need to know ahead of this intellectually stimulating and very well-informed combative few hours that we're looking forward to. Stay tuned. You're watching Squawk Box on CNBC.
Coming up, JetBlue throwing a big wrench into a big airline deal. We're going to ask a top analyst, which is better for investors, JetBlue with Spirit Airlines or Spirit Airlines with Frontier Airlines? And what's Washington going to think about all of this? Speaking of JetBlue, don't miss a big First on CNBC interview a little later today with the company's CEO. That's at 10 a.m. Eastern Time with our good friends on Squawk on the Street. Stay tuned. We're coming right back. Welcome back to Squawk. Members of the House and Energy Commerce Committee, we're going to be getting a chance today to grill oil company executives about high gas prices. Brian Sullivan joins us now with a preview of the big hearing. What kind of high drama are you expecting, my friend?
Oh, well, Andrew, it's going to be a grilling. I mean, there's 19 members of this subcommittee. You've got 11 Democrats. You've got 8 Republicans. So I have a feeling there'll be 11 grills and 8 non-grills. All right, so to give you a preview, and I know you guys did a great interview in the earlier hour, the hearing is called Gouged at the Gas Station, Big Oil and America's Pain at the Pump. So I think the title of the hearing should be a pretty good indication of how it's going to go. Starts at 10:30 this morning. You got the CEOs of those companies, Chevron, Exxon, Devon, Pioneer, and as well as execs from BP and Shell. And what they're going to want to know is, why is the price of gasoline so high when oil comes down? Why is gasoline up? We've explained that many times. But this is an interesting chart. In the past year, price of crude oil is up 75%. The price of retail gas, according to AAA, is up 45%. Now, when oil has come down the last couple of days, when it does, gas doesn't move because that's not how gas stations work. All right, here's what both sides are going to say, and then we can just chit-chat. Congress is going to say this. The 6 companies at the hearing made $76 billion in profit last year. True. Oil companies are spending more on share buybacks and dividends. Also true. And according to a survey, 50% of oil companies are not planning to raise production more than 5%. That survey coming out of the Dallas Fed. What the oil companies are going to say is that oil production is on the rise. Maybe not as fast as they would like, but it is going up. They're struggling with stuff, labor, supplies. COVID and the lockdowns crushed the industry. A lot of companies went bankrupt. There's all this talk about unused leases, Andrew. Well, what they're going to say is, yeah, we have leases, but they're tied up in lawsuits. There's permitting problems, et cetera, and that the drilling time has gone from 6 weeks to 6 months due to lack of steel, lack of water, lack of truck drivers, et cetera. So I expect it will be a grilling. You're going to get a lot of tough questions because gasoline prices, maybe more than everything else, Andrew, is something that American consumers see and feel weekly, if not daily, depending on their commute. And it's a political hot button heading into November 8th. Might have heard about this midterm.
That was the question I was going to ask you, which is, even if you think this is just drama and this is a bit of a sort of theatrical situation, it often does change the political conversation, the national conversation. It puts targets on certain people's backs. Sort of how do you assess that and what may happen after this?
Well, you ever watch Game of Thrones, Andrew?
I have.
You remember that scene where they're walking through the states? Shame, shame. I think this is largely going to be designed to put faces to the names. I guarantee you there's going to be mentions of the pay packages. Well, you made $20 million or whatever last year.
Right.
These kind of numbers are going to come up. Profits are well up from last year. We know that. But I will say this. From 2008 to 2012, oil companies made more money than at any time in history and will probably never make that much more money again. In fact, 2008 gross profits for Exxon, Chevron, everybody else were sky high because oil prices had also come up. So we've kind of been here before. Listen, driving demand, you guys have been on the roads, Andrew. Driving demand is high. Nobody's taking mass transit. At least they're starting to, but they weren't. And so you've got vehicle miles in many areas, not just here, but in places like India, soaring. The price of the entire supply chain is up. So from taking oil out of the ground to putting it in your pump, there's a lot of people each taking their cut. Is there gouging? It probably is at the local gas station because they lose money a lot. They're going to make it when they can, maybe some distributors as well. I'll tell you, though, who is probably printing money, according to Wall Street research that I've been reading lately, Andrew, and that is the refiners. The pure play refinery companies, because of what's called a crack spread and everything like this, may be making more money. Some of the oil companies on this panel don't actually produce or sell gasoline. So they might just deflect and say, we just take oil out of the ground and sell it to somebody else. Ask the refiners what's going on.
Fascinating. We will watch the drama unfold today. Brian, appreciate the preview. Thanks.
Sure.
When we come back, why does JetBlue think teaming up with Spirit Airlines makes $3.6 billion worth of sense? We're going to get into the latest potential airline deal and the snafu it's creating with another deal. That's all when Squawk Box comes right back.
Shares of Spirit Airlines are lower this morning, but they had surged 22% yesterday on news that JetBlue made a $3.6 billion all-cash offer for the discount carrier. That could upset merger plans between Spirit and Frontier. Joining us now for more, Colin Scarola, an industrials analyst at CFRA Research. We've heard what some other analysts were saying. Many said the same thing, Colin, and that is that JetBlue and its prey have a lot of overlap down south in Florida, and that could be a problem. But our own Phil LeBeau points out the total overlap across the entire country, that it would be that JetBlue actually has less overlap than Frontier. How do you view it?
I think if you look at where Frontier and Spirit would operate together versus Spirit and JetBlue, there's probably a lot more risk of taking competition out of the market on the East Coast if you let JetBlue and Spirit tie up. I think it's a matter of overlap that kind of brings the sort of antitrust lawsuit risk into this, but it's also a matter of just where these airlines compete on pricing. I think a Spirit and Frontier tie-up would remain a ultra low-cost carrier, but JetBlue's average tickets are about 40% higher than Spirit. So if you get a JetBlue as the sort of surviving management strategy and acquiring Spirit, I think, you know, the FTC, based on what we've seen out of them the last year or two, under the new administration, they're probably going to assume that Spirit's prices kind of track towards JetBlue. So higher prices, worse for consumers. So I see a lot more risk to this deal through that lawsuit.
So does that take away the premium that shareholders are being offered to accept the JetBlue deal? If you were a shareholder, would you say I'd rather go with a sure thing and go with Frontier?
I mean, if I'm a shareholder and I see you've got two things here. The JetBlue offers 27% higher than Frontier's offer, but it's also all cash. So there's no what ifs or does this work out down the road. You're getting your cash now. So I think I take that risk and I say, you know, give me 27% more money, and you know, it's not an IOU, it's cash on the table. I think you got to go with that.
With the regulatory risk too, because you could be, like Andrew mentioned, you may be waiting around a year and then you don't get it.
Yeah, and potentially you'd have to fall back to the Frontier deal if it's still there. But I think I would take that risk.
That's the part I don't understand. So you're going to take the risk of what will be a year plus long fight to get the deal done, and then if I could tell you today that the deal will not get done, how about that? Actually, why don't we just start there? Let's say the deal doesn't get done a year from now. You still take that?
No, I would not.
Okay, so
okay. I think there's an interesting component here.
Go ahead.
And there's also another reason this probably has a lot more antitrust risk, is you'd be going from 7 national airlines down to 6 if JetBlue gets Spirit. If Frontier gets Spirit, you'd stay at that 7, and you'd actually have a more viable candidate.
Right, so Colin, this is the part I'm misunderstanding or not appreciating about your argument. You're effectively saying it's a much harder antitrust argument to overcome on one side, but you're saying I'd still take the risk. And so I'm trying to understand that dynamic. What percentage would you put on this high risk deal? Actually, when you're calling a higher risk deal being approved, what's the chance that happens to you? By the way, I would be in the put it at 10% that it would get done the way, you know, unless you were to break up the company or really get rid of lots of routes or other things that would change the dynamic of the deal. That'd be my number. What would be your number?
I would put it more at 50-50.
50-50.
Yeah.
Okay.
Because you have to consider, Andrew, these airlines right now are not profitable at all. And a lot of them can make the argument with where oil prices are now and likely to stay there, they might not be profitable even in 2023. They're saying, you don't want us to consolidate, but if you don't let us do this, we might disappear over the next year or two anyway.
And
I'm not saying
that's going to persuade Lena Khan?
I think that's a pretty viable argument. Look, how can you say we're too profitable and we're going to be anti-competitive when we can't even make money in the current environment. You have to let us bring some consolidation into the industry. I think that's a pretty viable argument, and I would definitely put the odds much higher than 10% of getting that deal through.
All right, Colin, thank you. You're an airline analyst. Is it route or routes? We've been, because it's Route 66, isn't it? And then if you route someone in a game, you beat them badly, so that route should be saved for that. What do you do either? Do you have a preference?
Let's just call it an avenue.
I'm going with Route 66.
Just avoid the confusion altogether, and call a sporting victory a beatdown or a stomp. Then we'll avoid the confusion altogether.
Okay, all right. That's why you analysts, big bucks. Thank you. Appreciate your time today, Colin. See you later.
Thank you.
It's so fascinating.
I mean, why not try? Why not try? You see what JetBlue said? We're always thinking about things, but
I know, but the whole idea of we can't, we're going to lose money after. And by the way, after every taxpayer in America has basically
back to this. Gosh.
What happened?
Nothing.
First it was we can't survive without your money. Now we can't survive unless we consolidate so that we can gouge you more.
Consolidation has been going on for a while.
Sure, but at some point,
the more they've consolidated the really big guys, the other guys start looking around the room saying, "I've got to get bigger."
Oh, I understand why they want to do it.
Yeah.
I'm just saying that at some point
they're trying so they don't have to ask for money next time there's a global pandemic, 1 in 100-year event.
Right. They'd rather have a monopoly.
Bingo. Coming up, Jim Cramer's first take on the trading day ahead. We'll get his views on this airline merger and more, plus an exclusive interview on the recent market volatility coming up with Marcy Frost. She is the CEO of the nation's biggest public pension fund in the nation. You don't want to miss what she's got to say. Squawk Box coming right back.
Let's get down to the New York Stock Exchange. Jim Cramer joins us right now. Jim, we've been having this conversation all morning about what happens with Frontier, with Spirit, with JetBlue. You put all this combination together. How do you weigh the deals?
Well, I said in my club note this morning that if you go back to what happened between 2010 and 2020, There are a lot of people in the Democratic Party who wish that a lot of these deals had never occurred and felt that what they did was create a lot of anti-competitive mergers. I know that it was just a great moment where Phil said, well, Alaska get involved. Alaska did Virgin, American US Air, Frontier Midwest. And I remember at the time talking to a lot of the Democrats in the party who just said, I wish we had stopped these deals. So now we have the people in the agencies who are going to stop them, I believe. So these guys, one of the reasons why all these stocks are down is a recognition that the next thing you're going to hear from the FTC is, are you kidding me? Now, I'd really like to talk to the lawyers who are advising on this, because the lawyers are going to make a lot of money and also make fools of themselves. But they'll make money before they make fools of themselves. So this is very ill-advised on the part of every single one of these companies. Completely a terrible read of the FTC and the Antitrust Department of Justice, which is really anti these mergers.
Could the Spirit Frontier deal have slipped through without the extra scrutiny that the JetBlue bid is now going to put on this? So none of this you think was going to happen anyway?
Then we got this guy Cantor in the Antitrust Department. He's a very rigorous fellow. Now, we have a person in the FTC, Ms. Khan, who a lot of people feel is just a firebrand. But the person who's in the Antitrust Department is a great lawyer from Paul Weiss, and he'll never stand for this stuff. So, I mean, I think that these guys are wasting their time and wasting their money. And they got very bad legal advice. All of these mergers are ill-advised.
That's what I was gonna, is this a chill for every potential merger? If you're a company who's looking to buy, I mean, you can't think of an industry where.
Becky. No, they got to make a statement, and the statement is, okay, listen, we screwed up. We let all these airline mergers go, the Democrats, and we're not going to make that mistake again. So what we have to do is shoot down every one of these. So I think that one of the reasons why all these are down is a recognition that Justice and FTC are going to act together to slam the heck out of these. So, I mean, look, I really want to speak to the lawyers who said these deals are fine, because they remind me very much of the lawyers who checked off on ATT Sprint. I thought Andrew had some great points today about the breakup, and Phil, unbelievable about what's really going to happen. So, I mean, I think that people who want to buy these are, they're playing with fire. This is something that nobody wants this.
That's an excellent description of the stock reaction today, because if you think a bidding war is starting off here, it's not reflected in these prices.
Just go back to what happened to what the Democrats thought about what they did wrong in the previous administration. One of the things they most regret is they created a lot of anti-competitive mergers. And this was the area that they felt they screwed up in the worst.
Jim, thanks.
Sure,
we're going to hear a lot more about this from you in just a few minutes. Good to see you.
Absolutely. Thank you.
By the way, folks, we want to remind you about the new CNBC Investing Club. You can sign up to find out more yourself at cnbc.com/join the club, or just point your phone at the code on the screen. It will take you directly there. Squawk Box will be right back.
Welcome back to Squawk Box. Our next guest leads the nation's largest pension fund in the country, worth nearly $500 billion. It makes her the perfect person, really, right now to talk about finding returns in the current market as rates rise and big tech companies make what seems like a comeback. We'll see. Joining us right now is Marcy Frost, CEO of California's CalPERS. Marcy, it's great to see you. We're all trying to make sense of this market. We're going to hear from the Fed and what they're actually thinking at 2 p.m. Today. I know a lot of folks are focused on that and inflation. What are you focused on?
Well, we certainly focused on the long term first and foremost as a pension plan. But, you know, the structure within the markets, we think essentially that the Feds are getting some credit for the way that they've managed this to date. We did last November change we're in the process of implementing the new strategic asset allocation for the $500 billion portfolio that puts in a little more inflation protection. We certainly have some downside risk protection on our factor-weighted equities, which is about half the portfolio. But, you know, we're long-term investors. We're going to pay attention to the short run, but we're much more concerned if inflation were to stay at the rates. We know the Feds are working very diligently to try to control inflation. And again, long-term investors, we stay focused.
In terms, though, of how you're thinking about allocation, broadly speaking, both in the context of a lot of folks thinking about tech, but also how you're thinking about private equity venture, is any of this change as you start to look out over the next several years and think, I imagine, that we're going to be seeing meaningful inflation across the board?
It has. We actually increased our allocation to both real assets, infrastructure, as well as private equity, moving private equity up from 8% of the portfolio to 13% of the portfolio. Obviously, we'll have a bit of time to implement that strategy through our pacing model. But really, on the real asset side, increasing that also into double digits as a way of having some inflation protection in the portfolio itself.
Is there any thesis that you have about an impending recession? I mention this because Deutsche Bank out with a note today saying they're expecting a recession by the end of the year. Stocks perhaps down as much as 20%. Goldman Sachs has also been talking about the possibility of a recession. There's some that are moving money, I know, into private equity now because they think there's going to be an opportunity on the other side if, in fact, this bad news proves true and therefore becomes good news if you're maybe trying to pick up some stuff on the cheap later.
No, I mean, we stay committed to our long-term strategy. And again, the asset allocation on the private equity side, we've always had a pretty significant target to private assets, including a new allocation to private debt. You know, again, it's about diversifying the portfolio to withstand, you know, the various market conditions that we find ourselves in over decades. But we do think the position of the portfolio today is postured in a way that can withstand, you know, some volatility over the next, 4 years.
Within that sort of private equity pocket, where does venture capital stand and where does real estate stand?
So we have started to find some deals in venture. We have a new chief investment officer who just started with us on March 28th, Nicole Musico. And she's really looking at additional venture. Our private equity team has found some deals. Those deals tend to be a little bit small for the scale of CalPERS, but we've started to invest there prior to, you know, this inflationary environment. Real estate is in our real assets portfolio. When we really look at real estate as a part of the core portfolio, as both a bit of an inflation protection, but also an income source for the benefit stream that we have to pay to our 2 million members.
You've been a quite public advocate around the idea of ESG. Some have made the argument that ESG is a high, I don't want to say it's a high-class problem, but it's an issue that people think about when in a sort of bubble economy or when things are high, but it becomes harder to focus or prioritize some of those issues when things become more stressed. Do you agree with that?
I agree with it to some degree. Is that, you know, the short term, you know, if you've got energy security issues, you have food security issues with this, you know, war that Russia has waged on the Ukraine, you know, certainly food security is becoming more of a problem as well. But ESG, whether we call it environmental, social, and governance, it's really about long-term sustainable investing, and we remain committed to it. Whether it's climate risk reporting, the SEC just released some proposed regulations on transparency around climate risk, at least on the Scope 1, Scope 2. They put some safe harbor in on Scope 3. But we are in full support of more transparency for us to manage the climate risk in our own portfolios.
But given that, Marcy, the reason I ask is I wonder whether you say to yourself, you know what, energy over the next couple of years might actually be a good investment and might actually get us some returns. Is that something you say I want to do, or do you say actually maybe I don't want to do because I also have this ESG piece of my thesis?
We remain in. Our philosophy is that we hold companies for the long term, and we're going to be with them, whether there's a short-term energy crisis or energy spike, or whether, that the pricing of oil comes down or the pricing of oil increases. But we're really with these companies for the long term. We want to understand their transition plans.
Okay.
Those are longer-term transition plans. But, the portfolio and our commitment is to be net zero by 2050. That's not a policy issue. That's a financial risk issue.
Okay. Marcy, it's great to see you. We always appreciate your perspective on what's going on in the markets. Thank you.
Thank you.
Absolutely. Bex, you got some news?
Yeah, just real quickly, we haven't mentioned the Bank of America credit card data numbers. The spending came in for the March numbers up 11% year over year. Card spending per household up 6.7%. Airline up 91%. Restaurant spending up 17%. But they did say the lower households are starting to feel some pressure points. So there is a split there.
A little backward, forward looking at the same time. Okay.
Anyway, that does it for us today. Make sure you join us tomorrow. Right now it's time for Squawk on the Street.
Good Wednesday morning, everybody. Welcome to Squawk on the Street. I'm David Faber, along with Jim Cramer. Carl's on assignment this morning. Let's give you a quick look at futures as we get ready to start trading. Half hour from now, what Jim and I like to call the old hump day. Let's get to our roadmap this morning. It does start with Treasury Secretary Yellen's warning, saying, or being ready to tell Congress of the, quote, enormous economic repercussions from the Russia-Ukraine war. Plus, we've got a low-cost carrier battle, JetBlue's surprise bid for Spirit, and potential disruption for a Frontier's deal, but, well, here regulators may prove the real roadblock. And big oil's big Capitol Hill showdown. The CEOs of Exxon, Chevron, and others are set to face what may be a grilling over higher gas prices this morning. Let's start with the markets, though, ahead of Treasury Secretary Yellen's Capitol Hill testimony. Jim, had a few conversations this morning. There is real concern about a slowdown. A slowdown overall. Does the Fed engineer a hard landing? Look at the data, look at mortgage rates, look at what's coming from China or lack thereof. Globally, the economy is slowing. Just giving you some of my notes here. Want to get your reaction.
I think that's right, and I think that we got something that was really an amazing change from two Fed heads, so to speak, Brainerd and Daly. And what they're basically saying, and I think that there's a lot of truth to it right now, and I would summarize it by saying that inflation running at 40-year high is as harmful as not having a job, according to the Fed's Daily. I thought that was very good. And then we had some very thoughtful comments by Brainerd, who is really, I mean, it's gonna be she will be a number two, really talking about the idea that we're way off the rails here. Because the working person is going to get hurt. Now, these were people who very much protected the working person and were trying to get jobs. But now they feel that maybe they screwed up and went too far. A little remorse at the same time as maybe there was a slowdown to begin with.
All right, so what is that set up for? Is the bond market trying to tell us something here? I mean,
yes.
Is the likelihood of a recession growing with the Fed's continued plan to, I mean, maybe we get even 50 basis points the next meeting in terms of tightening and what does seem to be at least signs of a slowdown?
Well, what I would say is we have to look at there is an analog, and that's the October 2018 analog, where you saw a tremendous decline in tech in particular. And that was because the Fed decided it's time. And they talked it into a downturn. Most importantly, you saw tech down between 20 and 50%.
Right.
In 3 months' time. And that's what you have to be most worried about, because those are the ones that go down when they want to tighten. Not forget that. But also, David, I mean, I had I had a fellow by the name of Leo Ron on yesterday, $17 billion in freight run by Uber. And he traced out a scenario. He said some rates are down 30, 25. But of course, off a very high rate, they're up 60% year over year. But he made the point. He said, here's what we see. We see trucking finally easing up at the exact same time that inventories are building.
Right.
That's recession.
It is. Yeah. That's what you take away from that. Look, we've talked a lot about that, and there has been a lot of focus on the transports in part, and trucking in particular, but others as well, FedEx, even UPS, and just
UPS
what seems to be
killed.
Yeah. Yeah.
Well, that just shows
justified.
Major slowdown in freight. The transports are really signaling a slowdown. There's no let up in production, and yet we could run into a glut very quickly. Now, the 2018 scenario is much more of an attack on tech, just because that's the highest multiple. No reason to panic if you're in a lot of other sectors, but I think that we are. Let's just say the time to be more conservative is now.
You do? You think so?
It's now. When you have two Fed people recognize that, you know what, growth is hurting the working person instead of helping, because the growth is too high, but more importantly, inflation's too high. Well, inflation running at 9, and wages running at 5. That's a real slaughter to the working person.
You know,
Really
Barry Stern looked always worth a listen, even when he's completely wrong on carried interest. Kudos to Sorkin on that one. But I listen to Barry because he's very smart. This is what he had to say this morning on the Fed and the challenges ahead.
The Fed is going to have a challenge because I think the economy is slowing. I mean, global deglobalization is real. Imports from China are really, so the import numbers. I mean, we're buying everything, and it's all sitting in containers, and warehouses are full. There's a lot of problems in the supply chain. So costs are rising rapidly. Construction costs are up 10 to 30% year over year. So you either have to charge more to make it economic, or you're going to stop construction because nobody's going to pay you.
Of course, when it comes to residential housing, Jim, 5% mortgage rates may give people some pause as well.
You see some of these numbers that Diana Oak put out today, 41% decline in number of people trying to buy a home.
Yeah.
You know, in
that
New
can
York,
happen fast, can't
yes.
it?
Well, in New York, a month ago, you might have 5 offers for a place that's $4 million. And now you have none. They got to cut the price. So you're at that moment where, again, like Barry said, inventory builds. You know, there's buyer. They make inventory to equal the buyers. And then the rates go up, but they're still putting out inventory. That's what Barry said. And then you've got not a cliff, but a decline where the buyers walk away in almost everything. So what does that mean for the stuff that's sold at Home Depot? I mean, you have, let's use paint as a simple one. Like, paint's been putting through price increase to equal the raw costs. Well, at a certain point, people say, you know what, I don't need paint. And that's kind of where we are. Now, I don't want to portray this as dire. Don't forget, in 2018, they pivoted at the end. So you had October 3rd down to December 24th.
You keep referencing 2018.
Well, because that's when the Fed changed very aggressively. Very aggressively. And you had people who basically were kind of pro-growth, who suddenly said, you know what, wait a second. Maybe we're creating inflation. And David, rates were much higher. Rates were higher. Inflation was nowhere near where it is. Is Powell's Deutsche Bank has a note today that basically is a nuclear winter note. Fire and ICE, Mike Wilson too. You're getting these analysts. Now, if they all go negative, then
that's probably a positive.
Yes.
Yeah. I can't figure out where you are, frankly, these
days.
I'm
conservative. I'm growing much more conservative because yesterday was when Brainerd's speech was very thoughtful. And what she said is, look, basically, you know, I've been pro-working person, and that means we have to have growth. But now I know that I'm hurting the working person. So she's now allied. When the doves align with the hawks, you just have to be more conservative.
Right, but we're going to have higher rates into a slower growth?
Yes.
Okay.
See, well, in 2018, I wasn't ready.
Yeah, but in 2018, he backed off.
I wasn't.
You sat here and criticized him every day.
Well, backed off when everything was down 40%. Yeah, but what they're saying, I think what they're really saying is, you know what, rich people, we're not interested in your assets, and we don't care about the stock market. Now, we have a president who doesn't care about the stock market. We have a war in Russia where all we seem to do is, instead of sending them switchblades and javelins. We send them willy-nilly full ratchet. How many times are they going to ratchet up whatever the heck they're ratcheting up when Putin wants to kill people?
It's true.
See, like,
they seem to be doing a fairly successful job of defending their country.
We cut off, we decided aggressively to cut off the oil imports to Japan, and they bombed Pearl Harbor. Sanctions don't work. What works is, okay, listen, we're going to arm the people who are against you, and they're going to take back the land, and then see how you do.
You think we should be arming them even more so? Because it's not as though we aren't. And I don't want to get into a whole discussion about military strategy right now.
No, I don't mean to. I'm just saying that the sanctions themselves, I see we up them, and then I see massacres. Do you massacre people when sanctions are going up? Only if you don't think they matter.
Well, that's more about soldiers on the ground.
But you're right. I don't want to go. Look, I care more about.
I can't really draw.
I care more about an administration that may be anti-business, where it's now servicing. And I don't know when you want to go to the airlines.
I want to go right now. Let's talk airlines.
Jeez,
yeah,
okay.
Because that is
Why don't
a
you
good,
just get us right there.
Good opportunity to move to things we like to talk about, takeovers, the stock market. JetBlue does announce
things that are directly going to impact our viewers.
An unsolicited takeover offer for Spirit Airlines, valued at $33 a share. It is all cash, worth about $3.6 billion. Now, in February, Spirit did agree to merge with Frontier. That is a $2.9 billion cash and stock deal, and it's actually valued at a bit less than it was at the time because Spirit stock price is down. Spirit, for its part, says it will evaluate JetBlue's proposal, while Frontier claims the rival bid would, quote, lead to more expensive travel for consumers. By the way, don't miss a First on CNBC interview with JetBlue's CEO, Robin Hayes. That will bring you in the next hour. We'll talk to him. And, Jim, let's go right to it.
Sure.
Because what I hear this morning from my crowd knows a thing or two about their way through takeovers, not to mention myself, is the Department of Justice is probably not going to let either one of these deals happen. So it doesn't matter what JetBlue bids. You can bid anything you want. That's great. Maybe you do something here to stop the deal, but your deal's not getting done, and the other deal's probably not getting done either.
Well, so let's say that I was going to say exactly what you said. Should I say it again?
No, you can agree.
100%. Look, David, I want to attack some lawyers today, and I'm not talking about Shakespeare. First thing we killed the lawyers. I have a lot of lawyers are friends, but I don't know what lawyer would have given this advice. There's a fellow, but look, we all understand Khan, where she is, FTC.
Lena Khan at the FTC.
Well, we have not really heard from the most rigorous thinker, perhaps, in the Justice Department, other than Merrick Garland, who's Jonathan Cantor.
Right.
Now, Jonathan Cantor, I think,
Paul Weiss.
head of antitrust, yes.
Runs antitrust in the Department of Justice.
I think
so basically the equivalent of Lena Khan at FTC is DOJ antitrust. DOJ is going to get this, and DOJ really regrets allowing American Airlines to buy U.S. Air. Am I ahead of you? Yeah.
Well, I have some others that I did. I mean, when I was there, Southwest ATA.
Your color, man. Give me some color on this.
Okay,
color analyst.
All right, Jonathan Cantor is going to stop every one of these. And any lawyer who says that they're not does not know that Jonathan Cantor was one of the top, most rigorous lawyers at Paul Weiss. And the Obama administration cannot believe they let through American U.S. Air. They thought they realized, what were we thinking? Alaska Virgin.
They really do
How could we have been
that.
so wrong? Frontier Midwest. What were we thinking? So, Jonathan Cantor.
Not Lena Khan, Jonathan Cantor. Why are we showing Lena Khan's picture?
Because Cantor is, everyone should be scared of Cantor. What are they thinking? Now, David, I want you to be the high-priced lawyers who are saying this is going to be fine.
Yes.
Are they be fine for AT&T to buy Sprint?
T-Mobile.
T-Mobile?
Yeah. Yeah,
Were they
sure.
wrong?
Yeah. No, they were dead wrong.
No, but I'm saying this is the same lawyers?
I don't know if they're the same lawyers. I haven't actually had an opportunity to look at the ranks of all the advisors here.
For this advice?
Well, the lawyers get paid. The bankers only get paid when it actually gets done.
Well,
so the bankers are the ones who are upset when deals get struck down. The lawyers don't. They're happy. They're just collecting.
I think that Jonathan Cantor is going to go after the lawyers.
Why?
I think he's just going to go after the
What does that even mean? You can't go after the lawyers.
I think he's going to cite
They could be getting advice that says, listen, and by the way, the market share numbers, if completed, right, if JetBlue were to complete this, they'd have 10% domestic market share. That still puts them well into number 5.
Have you flown to Florida lately?
American is 21%.
Have you flown to Florida?
Yeah, not that long ago.
They're paying you to fly to Florida. Do you think you'll be paying them to buy to Florida? But no, I'm not kidding. The rates to Florida are so low.
Spirit Frontier would be 8%. So, I mean, you can make an argument, Jim, that says the market share that we would have would be nothing. We would still be a little bit more of we would actually be a better competitor. Now, that, 2 going to 1 in low-cost carriers, which is what Spirit and Frontier are looking to do. I don't know how the DOJ feels about that. And then JetBlue taking out a rival, to your point. Not sure how the DOJ feels about that. But you can make the argument if you're a lawyer that says...
Why do you say you're not sure when you know that you're sure? Why?
We never know where because, first of all, the companies... All right, if JetBlue were to succeed here, it's going to take a year and a half.
Right.
18 months. They're going to have to put up a huge reverse termination fee. They're not going to go hell or high water because most likely they're going to get challenged. All those things have to be taken into consideration, which is why all the stocks are down.
Well, I was saying, let's step back. Well, here's my color. Don't own the stocks.
Yeah.
I don't have to tell you whether Cantor's going to attack so-and-so. I'm just saying I wouldn't own him. That's my practical advice.
I think we
There, we took care of that.
Done.
Let's solve the next problem.
All right, let's move on to oil. Big oil executives. They are heading to Capitol Hill this morning, and they will face a House panel. That'll be hearing on, of course, surging gasoline prices. Plenty of theater going on there. Let's give you a look at futures. We got an opening bell about 15 minutes from now. We are looking
go into oil.
For a lower
That was
open.
cursory,
We got more to talk about oil, Elon Musk's inability to file the correct filing. A lot more Squawk on the Street straight ahead.